Hi, this is our first video for the Exam 2 review. So just some short lectures for you to watch to review some of the topics for Exam 2 so you can practice before you take the exam next week. So first thing I want to talk about is choosing which financial formula to use for your finance problems. So we have 4 formulas that we learned. So the simple interest, compound interest, the annuity, and the payout annuity / loan formula. Okay? And so what I want to talk about is how you decide which one of these to use in which situation. Okay? So the first two are used when we just have one deposit. Okay? So in both of these cases, with the simple interest formula and the compound interest formula, there's just one deposit at the beginning. Okay? So those two formulas only work when you've just got one time. Okay? There's not something monthly or yearly. It just happens once at the beginning, and the money just sits there in the account. Okay? For simple interest versus compound interest, so in these situations where you've just got one deposit, how do you decide which one of these to use? Well, this one, if it says compound, use compound interest. If it doesn't say compound, use simple interest. Okay? That's it. So if you've got a situation where there's just one amount of money being deposited at the very beginning, you just ask yourself, is it simple interest or is it compound interest? And it will explicitly say that. Okay, so if it doesn't say compound interest, use the simple interest formula. If it does say compound interest, use the compound interest formula. Okay, so that's those two situations. In annuity and payout annuity, this is where we have payments every month, year, quarter, whatever, right? And so that's both of these cases. Okay? So in an annuity or a payout annuity really, that's what it means, is that you're making a certain deposit or a certain payment every year or every month or something like that. Okay? So that's when you're going to use one of these two formulas. Now, how do you decide which one to use? Well, the annuity is used when you're saving money. When you're saving a fixed amount every month or every year. So like if you deposit a fixed amount in the bank account or you save a fixed amount, something like that. Okay? The payout annuity or loan formula, this last one, I have to sit down for this to get to the bottom of the board. Payout annuity or loan, this is used when you're withdrawing money, right? So this is one of the examples like the retirement account where they're taking out $500 every month from their retirement or something like that. Or if you're borrowing money and repaying. Okay, so if you're making a payment every month to repay a loan, that's when you use the payout annuity or loan formula. Okay, so just to review, easy to pick which formula to use. Okay, if there's just one payment at the beginning, okay, and then you wait some amount of time, years, whatever, and then you want to know what's in what you owe or what's in the account, that's either simple interest or compound interest. You pick depending on whether it says simple, I'm sorry, it won't say simple necessarily, but what it will say is it won't say compound. Okay? So if it doesn't say compound, use simple interest. If it does say compound, use compound interest. Okay? So that's that top case where you've only got one amount going in at the beginning. Okay? The others, if there's any kind of payment coming out every month, or payment being made every month, or deposit being made every month, something like that, you're either in the annuity or the payout annuity loan situation. Okay? Payout annuity, if you're saving a particular amount each month. Payout annuity / loan is if you're withdrawing a particular amount, or if you've borrowed money and you're paying somebody back. Okay? In which case you use this. Okay? So that's the idea. That's how you choose which formula to use. I'll shoot a couple of examples of ways to kind of make this choice in the next video.